basics, and then also let's get into some specifics about debits and credits and what I refer to as the rules of debit and credit. First off, what I've got displayed for you here is a very simple representation of an account. Okay, there can be a lot of accounts for a business, and they vary, and you will see similar accounts used, but to some extent some businesses may use some, others may use different ones, they may specialize, so there's a lot of variety with accounts. But this visual representation is what we refer to as a T account, and that's because if you look, you see a T here. Okay, this forms a T, and that's why we call it a T account. There are three basic parts to a T account. The first one is the top, which is our account title. Okay, so if this was, say, we were talking about the account cash, we would have cash up there where it says account title now. The other two pieces are the left side of the account and the right side of the account. The left side of every account is called the debit side, and the right side of every account is called the credit side. Okay? Now, debits and credits do different things to different accounts, and we're going to talk about that when I get to the debit credit rules. And it's very hard for beginning accounting students to try to wrap your head around debits and credits. Because if you're like me, I like a good definition for everything. Okay, well, tell me what a debit is. Tell me what exactly a credit is. All right, so get ready. Get your pencils ready. I'm going to give you the definition of a debit and the definition of a credit. And this will be true for all accounts that we're going to deal with for the whole semester, or for all of accounting in general. All right, so ready? Debit, the definition of debit is left, and the definition of credit is right. There is no other definition for these, okay? Debit is always the left side, credit is always the right side. Now we're going to say that we debit accounts or credit accounts, and based on that I'm going to know if we're increasing or decreasing them based on what kind of an account we're talking about. But the definition for debit simply is the left side and credit is the right side. I wish I could give you a better definition, but there isn't one because they are going to do different things for different accounts, as you'll see in just a minute. Okay, but this is just a basic, we refer to as a T account. It's going to show the activity in the account, all of the debits, all of the credits, and then we can add those up and get a balance in the account. So you'd add up all the debits, you'd add up all the credits, whichever one, you're going to take the difference, but whichever one is larger, that will be the balance in the account. So you'll have either a debit balance or a credit balance as well. Now accounts have what we refer to as normal balances also. Now I'm going to talk about that in just a second, but you expect to see certain balances in certain accounts. So if I told you a specific account, you would be able to know, oh, I should probably see that has a debit balance, or it should have a credit balance. There are normal balances in different accounts. Okay, so let's go on, and to get to those debit credit rules, let's look again at that accounting equation. I told you it was going to be a very important part of accounting, and it is. I'm going to refer to this as our accounting equation tree. Alright, so at the very top, the very first line there is just our accounting equation that we've been dealing with. Assets equals liabilities plus equity. Again, let me just re-emphasize again how important it is that you understand this accounting equation, and even more as I'm going to now give you some pieces or branches, if you will, of this accounting equation, or this tree. And when we get to debits and credits, they are an essential key of accounting. You must spend a lot of time getting this, understanding this, learning these rules. If you don't learn them now, you will not do very well for the rest of the accounting for this semester or successive semesters. This is a basic building block of accounting. You must understand this stuff. So please ask me questions, do extra work on this, spend time on this topic. It is very, very important. Okay, so this is going to show us, again, we've seen the A equals L plus E. Assets, liabilities, equities. We've talked about what assets are, what liabilities are, and what equity is. Equity, though, gets a little more complicated. Okay, you have assets, and we've talked about that classified balance sheet, and we can classify these as current, or maybe property, plant, and equipment, or investments, or intangibles. So we've talked about those, but they're all assets. They all operate in pretty much the same way. Liabilities are the same. Again, we have current ones and long-term ones, but that's just the difference between when we're going to pay them. but they all operate in pretty much the same way. Equities do not, however. Equity, we have two big accounts for your equities, and these are what we see on the balance sheet. You have the capital stock account, or if you're a corporation, you may have specific stock like common stock. And then you also have retained earnings. Now, we've talked about what goes into retained earnings before. And we've talked about how your income statement is so important because you have to do it first before you can update or get your retained earnings balance. And so this should make sense if you kind of think back to what we've talked about before. For retained earnings, there are three accounts that get into that retained earnings balance. Think of your retained earnings statement. What things are listed there to update our account? Well, one's net income or loss, and the other is dividends. And what makes up net income or net loss on your income statement? Revenues and expenses. So under retained earnings, you have three accounts: revenues, expenses, and dividends. And the reason we split equity up into all these different little pieces is because they don't all operate the same. Okay? So I want you to understand this tree and how it works. Now eventually, revenues and expenses and dividends all get put into retained earnings. Think about what we know about them. Okay? If you have net income, which one of these is larger? Revenues or expenses? Should be revenues. So that net income increases retained earnings. What if you had a net loss? What would that do to your retained earnings balance? It would decrease it. That's when expenses are greater than revenues. So if we split them apart, revenues increase retained earnings. Expenses decrease retained earnings. And what do dividends do? We've seen those on the retained earnings statement before. Dividends decrease retained earnings. So we need to know how those impact this, and how it flows into retained earnings. Okay? Now let's keep that in mind, and now let's talk about debit and credit rules, what I referred to already. Okay? Very, very, very important. In fact, if I could cover it up, let's just look at the account types right now. Okay? Just ignore the rest of this for the moment. Alright? This is that tree that I just showed you, just in a list form. Alright? You've got assets, liabilities, and then the broad category of equity. Under equity, you have that first indention, which are your capital stock and your retained earnings. But then retained earnings has the three accounts under it: revenues, expenses, and dividends. Okay? Remember, assets, there are a lot of different types of assets, but they're all pretty much the same. So there are several accounts we could list under that. Same with liabilities. Okay? And again, equity, I've listed for you those different little pieces. When we talk about debits and credits, I said debit was left and credit is right. And that's correct because they do different things. If you're an asset account and I said that I was going to debit an asset, so cash for instance, we're going to debit cash. That means that we're going to increase it. So assets are increased by debits. Liabilities are increased by credits. So if I said, oh, well, I've got an accounts payable and I credited it, that means I increased it. The opposite would decrease it. So if I credited cash, I would have decreased cash. If I had debited accounts payable, I would have decreased accounts payable. Okay? For the equity accounts, again, they're not all the same. Capital stock is increased by credit. Retained earnings, that specific account, because remember, revenues and expenses and dividends flow into retained earnings. Retained earnings itself is an account. So that specific account is increased by credit. Revenues are also increased by credits. And that makes sense because revenues, we said, increase retained earnings, so they act in the same manner. But expenses and dividends decreased retained earnings. So they're the opposite. They are increased by debits. Okay? Whatever increases an account, that's also what we expect the normal balance to be. So for instance, we said cash was increased by debit. I would also expect to see that cash has a debit balance. Now there are instances where that might not be true. Okay? Can you have cash that's a credit balance? You can. That would actually mean that you were overdrawn on your checking account, for instance. So you, again, don't expect to see cash that way. The normal balance is a debit. If we saw equipment, which is an asset, and it had a credit balance, I would know right away something was wrong there. I need to look at that. Okay? Normal balances. So whatever you increase the account by, that is the normal balance. This may sound like some crazy stuff, and what are you saying, debit, credit, this and that. This is pivotal. You must know the rules of debit and credit. At first, it's just going to be rote memorization. You need to just memorize this. You need to know that assets are increased by a debit, and therefore they're decreased by a credit, and the normal balance is a debit. Same for each of these that we have listed. You've got to know your rules of debits and credits. Otherwise, we can't continue on. You can't do the rest of all of our accounting work, because this is what drives the entire accounting system, is knowing debits and credits and how we use them in the accounting system. It's very, very important. It's how we turn that information into something that's more usable. So you've got to know this. Don't just say, oh yeah, I'll look at that later. Please spend lots of time on this. You must understand this and how to use it. Otherwise, the rest of it will not make any sense. Now, notice I also left blank normal balance on retained earnings. Okay? Technically, what you want to see in retained earnings is a credit balance, but a lot of times businesses don't have profits to begin with. They'll have losses. So they could have a debit balance or a deficit balance. That would be debit. What you want to see is a credit. So that one you can see either one. But again, the preference on retained earnings is to have a credit balance for that one as well. Start again, like I said before, to start with, you're probably just going to have to memorize. As we use this, because we will use this from here on out, these debits and credits, it will become second nature. It will become more natural. You'll just know it. You won't have to look at a sheet or kind of say, oh my gosh, what was that? Let me think about that. How would I memorize that? Or it will become much easier as we use it more. But right now, it is very important that you go ahead and learn this, if nothing else, again, than just memorizing this little chart, or however you want to memorize this best.